Imagine this. You have 47 billion with a B, $47 billion in rent checks that you can't escape from, and only 4 billion in customers showing up. That's not visionary. That's not even bold. It's a ticking time bomb. It's a countdown timer to complete and utter failure. Today, we're talking about WeWork. WeWork sold on a vibe. Problem, businesses don't run on vibes. They run on cash, contracts, and consequences. And today, we're going to dissect one of the biggest hyped startups of our generation and how they flew their business directly into a mountain, taking billions of dollars with it. And what lessons you as an investor or entrepreneur can learn from their mistakes so that way you don't make the same ones. This is 2010. Two founders, Adam and Miguel, have a simple pitch. Office should not feel like work. It ought to feel like a community. Free beer, glass walls, dogs roaming the hallways, a startup Disneyland where hustle can meet lifestyle. The timing is perfect. Post 2008, companies wanted flexibility, startups wanted to be cool. And investors, they smelled disruption. WeWork positioned itself as a tech company, not real estate. The world bought it. In less than 10 years, they went from a single Soho location to over 800 locations globally, raising billions along the way, peaking at a valuation of $47 billion. To the public, WeWork wasn't just renting office space. It was redefining work in and of itself. And internally, people felt like it was a rocket ship that was literally unstoppable. But behind the kombucha and community, the numbers were rotten. 2018, WeWork brought in $1.8 billion. They lost $1.9 billion doing it. That means they were losing $1 and a dime for every dollar they made. Still, Adam Neumann, a charismatic CEO and founder, kept selling the vision. And here's where the story shifts from hype to hubris. When WeWork filed its IPO in 2019, the world for the first time really got a peek under the hood. What did they find? Simply put, a company with $47 billion in long-time lease obligations and only 4 billion in customers showing up. Think about it this way. They are locked into 5, 10, 15, even 20-year terms on this real estate. And customers can leave with a 30-day notice. That's not a moat. That's a mismatch. And then they got creative. EBITDA. What businesses are evaluated on, the earnings. WeWork introduced a new financial metric, community adjusted EBITDA. Community adjusted EBITDA. Now, EBITDA in and of itself already removes things like interest and tax and depreciation, amortization. But WeWork, they decided that they were going to strip out even more things. They stripped out the cost of actually doing business, things like marketing, general admin, even the leases themselves were stripped out so they could show some level of a profit. A profit that wasn't real. This turned financial storytelling into true financial fantasy. And then came the scandals. Adam himself personally charged the business $5.9 million for the rights to use the word we. Think about that. Imagine your CEO trademarking the company's name and then charging the company back for it. That's not just bad math, that's bad governance. In August of 2019, WeWork removes its IPO filings. By September, the business was in flames. Business analysts started to tear apart the numbers. Investors started to really see the house of cards that was built. And, well, frankly, confidence collapsed pretty much overnight. The valuation of the business plummeted from $47 billion into single digits. And Adam, the founder CEO, steps down. And what really happened was, let's be honest, the board kicked him out. And SoftBank, the bank, the largest investor, the biggest backer of WeWork, is now in some trouble. So they had to swoop in with $9.5 billion in bailout. The leadership at SoftBank that oversees their visionary fund to this day calls it their biggest mistake. But the problem wasn't just leadership or even more than creative financial accounting. It was a structural problem. You see, then 2020 hits. Nobody's looking for shared workspaces. And all of a sudden, overnight, WeWork goes from a massive growth business to one in absolute survival mode. They were in triage mode as a business overnight. Fast forward to 2021. The world's starting to come out of the COVID haze a little bit. WeWork, desperate to get public, goes with a SPAC, SPAC. Day one on the market, $9 billion valuation. Far cry from the $47 billion crown jewel that Wall Street once saw. November 2023, the bomb finally goes off. WeWork files for Chapter 11 bankruptcy. The goal? Cut the weight, cut the extra, slash the debt, and renegotiate all their leases. By May of the next year, 2024, the court finally approves the plan, and on June 11th, WeWork is a private company again. This time, owned by its lenders and real estate software, Yardi Systems. They wiped out $4 billion in debt. They cut billions in rent obligations. They shrunk down to about 600 locations in 37 different countries. They name a new CEO, John, who's a seasoned real estate operator. And at one point, even the old founder and CEO, Adam, tried to buy the company back in 2024, but it fell through. Even he had to walk away from his own creation. So let's talk about what this means for you as an entrepreneur, as an investor, as a leader of your own business. What does this mean for you? Simply put, 3 lessons. Number 1, match your durations. If your liabilities are long-term, your assets better be long-term too. WeWork was playing Airbnb with 20-year obligations. That's a complete mismatch that you cannot survive. Number 2, governance is a moat. You see, when a CEO is selling trademarks to himself, that's not eccentric, that's corrosive, and proper governance will protect the business from implosion. And finally, number 3, narrative is not cash flow. WeWork was built on story, not on a system. The story raised the money, the system just burnt it. And that's the difference between momentum and mastery. Hype can get capital all day. Habits will build your business. WeWork was not just a collapse. It's a mirror. It's a reminder that principles will never bend to vision. Markets will shift. Principles won't. I'm Dr. Michael Hartley. Make it a great rest of your week.